y'all, it's Liz Wilkie. I'm the principal economist at Gusto, and welcome to the third quarter Economy Explained. The Economy Explained is a quarterly assessment of what's going on in the US economy using our own data, using government data. It's really sort of taking stock of what's going on now, what that means, what's coming down the pipeline, but also what to do about that, what it means for small businesses and the people that advise them. For those of you that have already watched a few of these, you'll know that I've been talking a lot about the tight talent market, and we're now in what I sort of call the forever talent shortage, which means there's going to be a lot more jobs than the number of people available to fill them for, I don't know, a pretty long time, to be honest. We keep keeping track of that jobs per unemployed number, and it's coming down a little bit, but really not so much. We're also going to talk about those rising interest rates, and specifically, we're going to talk about what that means for small business financing, just like we talked about last time a little bit, but we've got some updated information there. And we've talked a lot about consumers, which is the demand side for businesses, and we're seeing a little bit of slowing, or what you might call a stabilization of that consumer spending. Consumers are getting a little more cautious. Even though most of them actually feel pretty good about their situation, the general vibe is kind of slow, and people are just starting to get a little more nervous and a little more price conscious. What does that mean for a small business? Or if you're advising a small business, what does that mean for you to advise a small business? First is, again, retention. So, talking about retention, I've talked about this a lot, but it's still the same game, right? So the people that you worked so hard to bring on, really think about how to invest in them, how to do their development, but also how to get the right benefits package in place. And then for those of you that still need to get more talent on board to replace people that retired or to replace people that have quit, really there's just a world of opportunity in global, fractional, and freelance employment, right? So thinking about who you can hire outside of your local area, or honestly, even outside of the country if they have the right skills and talent to do it. And then also getting really creative about what can be contracted out to freelancers. And there's been this explosion of freelance and contract workers who are really striking it out on their own. And that's a really useful source of talent for you as a small business, or if you are advising a small business, to help them think through how to fit that into their budget and into their workforce plan. And then so for thinking about that more expensive financing, it's going to be really important for businesses to focus on cash flow. So as the economy cools just a little bit, we'll expect maybe some late invoice payments or a little bit of deferred payment, and that's going to be really hard on small businesses. But also then on the financing side, if small businesses maybe didn't get an invoice and they need to put something on a credit card or get a short-term loan, that's going to be more difficult too, because financing is getting more and more expensive as businesses have tightened credit lines. Thinking about the consumer, you'll want to focus not on sort of bargain basement shopping, right? Most consumers now are themselves feeling pretty good. They're just getting a little bit nervous about what's coming down the line. So focusing on mid-level pricing, discounting, and some sort of add-ons or like plus-ups, right, to products and services to make people feel like they're really getting a good value without necessarily sort of slashing prices because the consumer is really drawing back. That's definitely not happening, but businesses can do a lot to sort of hit their consumers at the mid-level. All right. Talking more in depth about that forever talent shortage. First, the good news. So there's been a 7% reduction since last year in the rate of new hire pay. So year over year, on average, businesses across the United States are paying 7% less for a new hire. That's mostly driven by the turnover in these sort of in-person services and seasonal work that have a bit of higher churn. So nail salons, summer camps, restaurants, tourist places aren't paying as much for new hires as they were last year. And that is a welcome change. But we're also seeing a reduction in the quits rate, which we think about as a sign of worker confidence, right? So If you think that you can get another job out there in the world really easily, you're just going to flip right from job to job, or you might be more likely to do that. And so if you are a little bit more nervous or you really found a good fit, right, that's going to drop the quits rates. And what it really means is that businesses are starting to get workers for a little bit longer, and they're also starting to get a little bit more engagement and commitment out of workers. And so that reduction sort of means that workers aren't feeling quite so confident, and they're also willing to invest more in their employers. And that's really good news for employers because it has just been really hard for businesses to sort of find and keep people. And that seems to be slowing down just a little bit. But the tough side is we are still in an incredibly tight talent market. So last time I did this, there were 1.4 jobs for every unemployed person. Now we're back up to 1.7, which is still way down from November when it was 2 jobs for every unemployed person. But this just means that we're going to bounce around in a space where there are way more jobs for every unemployed person in the country than there are people to work those jobs. The way to work around that, right, is to focus on retention through benefits and development. Do you have the right compensation package? And it's not all dollar comp. Benefits like 401k have a huge return on investment for their cost in terms of the reduction in the risk of a worker quitting in the first 12 months. And also workers really value things like hybrid, remote, and flexible work, as well as other sorts of tax-deferred benefits. And also learning development and career development, especially for younger workers who are at the front of their career path. They really do value the opportunity to grow and to learn new skills and to take on new responsibilities. So really start now and make those investments and then just watch it pay off over the next 6 months, a year, 2 years, and beyond. In a similar vein, focus on global, fractional, and freelance employment. These are what you might think of as non-traditional worker types and styles, but they're really becoming a core piece of the workforce for small businesses, according to our data. And they are really helping to alleviate a lot of the talent shortage that so many small businesses are facing by finding the right talent in the UK or Canada or the Philippines, or by getting a contractor, right, to do something that you can't currently find an employee to do. And then also part-time employees. Part-time employment has been really trending, and we know that workers are sort of reevaluating what it is they want to spend their time on. And so a lot more people are looking for part-time work, and that's really an opportunity for small businesses. Moving on to financing. So it's getting tight out there for small businesses. A lot more banks are tightening their loan standards than loosening them. They are reducing the credit that is available on a line of credit or a credit card. And almost 60% of banks are increasing the cost to credit rather than decreasing them. So what this really means is that businesses that need to go to credit markets, either for a short-term loan or a long-term loan or a line of credit or a credit card, are really going to face much higher costs than they were this time last year and way higher than this time 2 years ago. What businesses will want to focus on is cash flow planning. And this is really important because cash flow can be really variable for small businesses from month to month, as so many of you know. Planning out, 4, 6, 8 months. Is there a place where there's an elevated risk that you may not bring in enough to cover all of your payments? And what's your contingency plan for that? Where can you find extra cash or opportunities or resources that you have now instead of getting to that point and then being surprised? Also, focus on retained earnings and cost savings. Working with clients is a great opportunity to help them really think through where could they be saving money, and also where can they be reinvesting money back into their business, but also keeping it on hand in case a surprise comes up, as they often do for small businesses. And then really have a conversation about the R&D tax credit because it can be applied directly against your payroll liability tax. So you don't just get it once a year when you file your annual taxes. You can apply it every time against your payroll tax liability. And that can really enhance some of your cash flow health. All right, now let's talk about the consumer, who's such an important part of small business success. The consumer of 2022 could not spend money fast enough. They were making it rain, and that is what drove a lot of the inflation that we are currently trying to counteract. Consumers have repeatedly defied the expectations of economists that rising interest rates would make them a little skittish and that they would quickly pull back spending. We definitely have not seen that happen. But what we have seen in this last quarter is the first inkling of a flattening of consumer spending. Consumers are getting a little bit more cautious. They are actually not really feeling a whole lot of stress for themselves, but they are kind of looking around in the world and thinking, I'm not quite sure what's coming down the road, and maybe I should start thinking about being a little more cautious, but let's think about that as we go out for dinner, right? So their spending is still really robust. The vibe for them is generally that they're in an okay place, but they don't know if everybody else is in an okay place. And they're not quite sure what to think about that. So they're good. They're in a good place right now, but they are also a little bit nervous and they're becoming a little more price conscious. And we sort of expect that to keep stable or even dip a little bit into the end of the year. I'm going to show some numbers here about consumer credit and consumer spending. And the big number here is that there's been a 46% increase in consumer loan delinquencies. That feels like a really big number, but you can get a really big number when you have an increase off a really small number. So to put that into perspective, this is a 46% increase from the pandemic lows of 1.5% delinquency rate, which honestly, this just gets us back to the delinquency rate pre-pandemic. So it's really kind of a return to normal. I don't want you to freak out about that big number, but it is a signal that consumers are weakening just a little bit. And couple that with a basically flat spending change month on month for consumer spending means consumers are just sort of slowing down, taking a beat, and sort of figuring out what's going on before they start making more buying decisions. What should small businesses do about that? One, we don't need to overreact here. Consumers are still very strong by all indicators. Focusing on mid-level pricing, not ultra luxury, not bargain basement, and really sort of thinking about how to put add-ons or discounts onto products and services to really help consumers feel like they're spending their money wisely and without necessarily putting too much on the table. So focusing on discounts or sales, and also understanding that consumers may be a little bit nervous about entering into long-term contracts. So if you're a subscription business, you might think about a 3-month or a 6-month, right, package instead of a 12-month or an ongoing, is one of the ways that you can help consumers feel a little bit more comfortable as we enter this environment where they're feeling a little bit of slowing. The things I'll end with here are 2 big unknowns that we don't know about the economy. Overall, the economy is in a really healthy shape. We clocked 2.4% annualized growth this quarter, and we clocked 2% annualized growth last quarter, when at the beginning of this year, everybody was projecting 0 to 1%. So the economy really is incredibly robust. But there are 2 things that we really don't know how they're going to turn out by the end of the year. We at Gusto are keeping an eye on them, and they're just big question marks for us. So the first big question is commercial real estate loans. And if that doesn't sound like anything you're interested in, I understand, but it is actually really important. So a bunch of offices that were built in 2016, 2017, 2015, they basically get financed for 7 to 10 years, and then they roll over and they have to be refinanced. But when they were built, office occupancy rates were really high and interest rates were really low, so they had these very favorable loans. But now, interest rates are really high and occupancy rates are really low. So whether or not those loans can be refinanced favorably is going to determine whether or not they go into default. Their default is important because small and community and regional banks hold a ton of those loans, and those same kinds of banks also service small businesses. So we're going to be keeping an eye on how that goes, and also whether or not it spells any stress for small, local, and community banks that also serve small businesses. And then the second one, from a consumer spending perspective, is what happens in September when $86 billion of student loans have to start being repaid, and we see whether or not consumers pull back and whether or not that really affects spending in the economy. So we really don't know. The student loans in the economy are not a huge proportion of total income or spending, but they could have a disproportionate and outsized impact. To sum up, Really, what you need to focus on as a small business or somebody that advises a small business is retention through development and benefits, global, fractional, and freelance employment. For cash flow, think about how to find savings and how to defer investment. And also then for consumers, think about how to price in the mid-level, how to feel like they're getting a good value, and also help them feel like they're not necessarily committing to something for the long term. That's it for the Economy Explained Q3. Thank you guys so much for being here, and I'll see you next time.